Mr. Yves Bonzon, Chief Investment Officer at Julius Baer, welcome for this conversation with Qatar's leading newspaper, the Peninsula.
Thanks for having me, Deepak. It's a pleasure.
So, can you please share your thoughts on key investments to be considered in the portfolio amid a high interest rate environment? Does fixed rate savings bonds, FTSE 100 ultra high yield dividend stocks could provide opportunities?
There are many opportunities. Actually, the opportunity set today's in market is better than it's been in probably half a generation. We lived an extended period of financial repression. Bonds were on purpose priced by policymakers for confiscation. And we expected actually this bond bubble to deflate in a very gradual, very orderly manner over the course of a decade or slightly more. What we thought would take 10 years has happened actually in 2 years. Interest rates today are fully normalized. We actually think in the short term they've slightly overshot. And therefore, this opens a wealth of opportunities, not only in equity markets, but as well in fixed income markets. We all wish we could time the market perfectly, and that applies equally to stocks and to bonds, but fortunately or unfortunately, that's not the way capital market works. We believe rates have actually slightly exceeded equilibrium today. 10-year real interest rates in the United States, 2.5%. That doesn't look sustainable to us. And we think rates might stay elevated for a while, but they should eventually normalize. We see no evidence of a recession in the United States in the next 6 months or so. So we think this is a time when one wants to be invested. There are opportunities to buy cheap hedges in a multi-asset portfolio context by buying very cheap long duration treasury bonds. And you don't need to allocate much capital to that to create the hedge in your portfolio. And then high yield, 9% and above, even quality high yield in the high 8%, emerging corporate bonds, which will have very favorable technicals going forward with more redemption than issuance. All of these are great fixed income opportunities. You know, these yields are actually close to equity return with a fraction of the risk. The key metric in equity investing is free cash flow generation. Therefore, free cash flow margin, how much free cash flow a company produces as a percentage of revenues, and how much you pay for it, the free cash flow yield. And the fact of the matter is in 22, above and beyond the rate shock that impacted equilibrium valuations, we had on top of that a temporary reduction in the free cash flow productions of those leading technology platforms, simply because in the wake of the boom they experienced in 20 and 21, they temporarily overinvested, overspent, capex increased, they hired a lot. As you may have noticed from the result publications of, for instance, Meta, where management did an incredible job of adjusting the cost base, they have significantly reduced their cost, and immediately the free cash flow production recovers. So I think part of what you've seen in the surprising performance of these names in 2023 so far is not only the fact that business has continued to be strong and their results were certainly solid so far in the third quarter, but also the fact that free cash flow has recovered. When you look at sectors, there are not many very provocative outliers. You know, in markets, sometimes valuations are extremely provocative, cheap or expensive. And then you don't need to make forecasts about the future. The valuation is so expensive or so cheap, the market is telling you what to do. We don't have that set of circumstances today, maybe with one exception, healthcare. In healthcare, you have very provocative valuations because Eli Lilly and Novo, with their obesity drug, have performed amazingly well. Their market capitalization have increased tremendously. And essentially the rest of the sector has been completely ignored, neglected, sometimes pressured with an expectation that one of the impact of the widespread use of obesity drug will be to reduce other types of health conditions, comorbidities, etc., potentially hurting some business franchises of players in diabetes, etc. So there you have wide valuation dispersion. You have some stocks that trade at extremely depressed valuation on key relevant metrics. That's certainly one outlier. In banks, we think back to fixed income, there are still opportunities in the contingent convertible subordinated bank bonds market. In the wake of the full write-down of the Credit Suisse CoCo as part of the UBS takeover, the market will probably go back to the basics when this market was created in the early decade 2010, which means write-down CoCos are unlikely to be issued going forward. The market will go back to issues that convert into equity if the triggers are fulfilled. So in banks, it's a close call between equity and subordinated bonds. So again, it's a sector-by-sector approach. And by the way, just to be clear, fundamentally, we are not big believer in sector bets. We've studied the topic extensively. Making sector bet is not a reliable source of excess return.
And lastly, can you please comment on the tensions in Middle East, which has affected how it has affected the asset classes, and what does this mean for the investors?
Yeah. Of course, when people see these events, very tragic, emotions increase, risk aversion increase, and this pushes up the prices of some assets. Obviously, gold was one. And we think above $2,000, gold has a significant geopolitical risk premium embedded in the price. So we advise clients to sell calls on their gold position and certainly not buy at these levels. Oil, we have a fundamentally cautious view on gold. We think the market is balanced between $70 and $80. We think the US administration, with an election next year, wants oil prices to behave. So they're trying by all means to prevent contagion and a sharp increase in oil prices. The efforts are obvious, I think, for everyone to see. But fundamentally, we think the market is well supplied and there's no structural reasons for oil prices in the hundreds. And the key point here is you don't manage your assets, you don't manage money by making geopolitical predictions. Doesn't work, because actually nobody knows what will happen in Gaza. Even the Israeli prime minister, even the head of Hamas don't know how things will play out and what will happen. So nobody can predict this. And all you can do as an investor is take advantage of market overreaction in the short term. When they happen, we mentioned gold, to act appropriately, trade your position, sell volatility. But you cannot shape a portfolio or an asset allocation by making prediction on the outcome of such events.
Mr. Yves Bonzon, thank you for your precious time.